Welcome to our channel. If you want to avoid emotional investing and make rational financial decisions, follow these step-by-step instructions to protect your portfolio and achieve long-term success. Step 1. Create a clear investment plan that outlines your financial goals, risk tolerance, time horizon, and asset allocation strategy. Having a written plan helps you stay focused and avoid impulsive decisions based on market fluctuations. Step 2. Stick to a disciplined investment strategy, such as dollar-cost averaging, where you invest fixed amounts at regular intervals regardless of market conditions. This systematic approach removes emotional decision-making from the equation. Step 3. Avoid checking your portfolio too frequently, as constant monitoring can trigger anxiety and lead to unnecessary trading based on short-term market movements rather than long-term fundamentals. Step 4. Educate yourself about market cycles and understand that volatility is normal. Historical data shows that markets recover from downturns over time, so panic selling during crashes often locks in losses rather than preserving wealth. Step 5. Diversify your investments across different asset classes, sectors, and geographic regions to reduce risk and minimize the emotional impact of any single investment performing poorly. Step 6. Set predefined rules for buying and selling based on objective criteria like price targets or fundamental changes rather than gut feelings or market panic. Automating these decisions removes emotion from the process. Step 7. Work with a financial advisor or accountability partner who can provide objective perspective during volatile markets and help you avoid making emotional decisions that could harm your long-term financial goals. Step 8. Take breaks from financial news and social media during market turmoil to prevent fear and panic from influencing your investment decisions. Don't forget to like this video and subscribe to our channel.